Hello, founders. We're here with a very special guest, Matt Lekawa, and he is the founder of Transend. Are you the founder or co-founder?
I am the founder. We have four founding team members that have joined, but I am definitely that person that, how do you describe it, jumped off the cliff and built the plane on the way down.
Sounds good. So it all started with you, your brainchild. You brought on some founding team members. Let's do the too long did not read that everybody is going to be curious about. You initially raised a pre-seed round of how much?
So we raised about $1 million in a pre-seed round.
Pre-seed round. All right. And have you gone on to a seed yet, or what's the status of your fundraising?
It's a great question. So we raised about $1 million, and we thought we needed about 1.5 to kind of close out the round. And luckily enough, we ran across some success that from a demand and supply side of what we're going to accomplish, that actually gave us more runway than we needed. And so we closed the round out at $1 million and said, we're good to go. Let's go launch. So we haven't really raised yet again, and then hopefully we don't have to.
That's a perfect segue into the next part in terms of the mentality. But tell me, who did you raise from in terms of who are your investors right now?
Man, that was a journey in and of itself, because I'm a first-time founder and I don't really have a ton of connections inside the venture capital community. First time was just going out and just spraying and praying in terms of any VC that would give me a look. Really wasn't until I found our friends at Startups.com that kind of pointed me in that right direction, that said, look, you need to start looking at smaller VCs. You need to look at more micro VCs, even looking at folks that are specifically targeting your area and your geographic region. That's when we really found success. We got a couple of VCs on the cap table. Really excited about the partnership there, because some of them have great regulatory experience, which is a huge help for what we're about to accomplish.
It's great because we love referring founders like you. We're going to talk about how you tick off some of the boxes to make it easier to raise that pre-seed round. But then let's also talk about your inflection points. So you're just telling me before we start recording this, you got some exciting inflection points, which we talk about the moments in time where your startup suddenly increases in value because you had a breakthrough. You spend years trying to become an overnight success, so it's grinding away, but you hit that, you refer to it as the puck dropping your way. Everything comes together. You hit a few inflection points. Tell me about those in as much detail as you can.
Yeah, so the journey as most founders will probably tell you, you're kind of go out and accomplish a whole bunch of things all at the same time, and chasing that lightning in a bottle, as you described it. For us, it was trying to build out the demand equation for what kinds of customers and suppliers would need our product. And then on the other side, we have a supply equation problem, which kind of funding partners or bank partners would be willing to partner with us to go out and prove that this is a great asset for bank partners. Those are tough equations to bring together, especially when you start thinking about the regulatory environment and just the fact that these are two enterprise clients. And I always said you have to have the puck drop in your way, at least in the early days, to get that success. And right before the new year, we got some decent sized partnerships on the train. They just recently inked their deal, one on the bank side and the other on a Fortune 250 supplier side. So that was as of this month, and we're launching here next month, which brings us into that pivotal point when you go from pre-seed to seed and A raise, which is that thing called post-revenue, which is a beautiful thing to be able to say.
Let's put it into the ballpark. We're talking 9-figure deals here. All right. This isn't like chump change for everybody's watching. It's not like you're dealing with $50 or $10,000 even. We're talking 9-figure deals.
Yeah, our bank partner committed to over $100 million worth of line there, and the supplier side, they do $17 billion a year in revenue. So the runway for us just got a lot longer, and it's a 3-year contract. So we got a business here.
Beautiful.
A couple of slides.
Fantastic, man. We're celebrating with you. These are the types of stories that just get us excited to get up in the morning. But in essence, really, if you've got a banking partner willing to give you $100 million line, that's like raising in of itself. Like, you got to jump through a whole bunch of hoops for them to even sign the dotted line for that.
1,000%. Yeah, that's not a one-day process. That's not a one-call close. That takes a long time. And luckily, like, I've had a background in this space with bank partnerships, so it wasn't something that I was new to, but going through it as a startup where banks expect you to be a 15, 20-year-old company and have all of your policies and procedures documented, your SOC 2, Type 2 compliance ready to go, all of your certifications kind of like ready and available to be reviewed. Those are challenges for startups because those are very expensive. They take time, and that's not two things that startups normally have, is time and money.
So. Love it. Now everybody's wondering, all right, we're talking about raising $1 million pre-seed. We're talking about $100 million lines, Fortune 250, $17 billion. What is your startup? Give me the 1 minute elevator pitch.
1 minute elevator pitch. Transend has created a new payment type in B2B sales. And that new payment type is essentially what we call private label working capital. And I think the best way to describe it is essentially, we feel like every supplier in B2B needs to find ways to provide their buyers new ways to pay, innovative ways to pay that help grow their sales and actually drives loyalty. Everything we saw today was tough. Everything really focuses on the end buyer. And what we have provided is a way for suppliers to offer promotional terms to its buyers that start from 30-day net terms all the way out to 60 months and credit lines that are only available to be spent with them. And we do all that instantaneously, digitally, and promotionally. Long story short is we've invented a new way to pay in B2B commerce.
Fantastic. And I'm very familiar with the pain points because if I'm a buyer and I'm trying to manage inventory and requires tremendous amounts of cash flow, cash is king, I'm going and taking out stupid loans. I'm doing really unbelievable things just to say, all right, just I need the product so I can sell the product. There's a chicken and egg scenario. So you went and saw that problem. You said, hey, what if we could actually have the supplier themselves provide that credit, which, as you said, has not been done before?
No, it's exciting. And what I love about it, the whole business model, what really wakes me up inspired every day is because it's a truly win-win-win scenario. You've got a buyer who gets access to incremental credit, just like you said, at promotional terms. Meaning if I wanted working capital, I could go to a bank today. They'll give you a line. It'll probably take them 30 days to do it, but you'll still get a line. Very, very inefficient. They don't get the subsidy that a supplier is willing to give you. So the other side is the supplier has margin on their side. They want to lean in to help the sale get facilitated, and they're going to contribute that in terms of a discount and create a promotional opportunity for the buyer. What the supplier gets inherently is larger sales, better loyalty, and instantaneous cash flow because they're getting paid up front and they don't have to wait 30, 60, 90 days, 120 days, 2 years to get paid.
And as a supplier, I've got the information on the buyer. They're establishing track record. I know they're going to spend the money with me, and it only behooves me to sit on their side of the table with me. That's completely different from them going out and putting it on credit cards or going and getting a bank credit, where me as a supplier, I don't know what the buyer's going to do with that. So now I'm protecting the relationship. I'm incentivizing all of us to work together. Truly that win-win-win scenario for everybody.
One of our suppliers said, Matt, we pay MX 4% every day and we hate them. I would happily pay you 8 and love you. And I was like, that's great. I'm going to use that. Thank you so much. The last win is really the bank, the funder, the partner on the funding side. You think about the bank partners, most of them community banks, they don't get access to these kinds of credit relationships. And in order to do so, most of these guys are chopping down the Amazon rainforest, spending $3,000 to $5,000 to acquire one account. Whereas if they partner with us, there's no cost of acquisition. We do all the servicing as the master program administrator, so there's no OpEx. And you get access to a hyper premium asset class with amazing returns. And so for all those reasons, that win-win-win scenario is being delivered on the Transend platform in a digital way, which is great.
Let's go back to the beginning. So 2-part question. How did you pick this problem to work on? And then what did you do to even validate that this should be a problem we're working on and turn it into a startup?
Oh man, I wish it were a better story. So I've been in this partnership finance space for a very long time, my entire career, as kind of an intrapreneur. And so I got recruited by some companies to come out and like build buy now, pay later facilities when buy now, pay later wasn't even a term, point of sale, private label credit card for consumer. And throughout my career, I always kind of see deals out there that didn't quite fit the commercial space, but a need was there. The one that just hit me like a brick over the forehead was building an entrepreneur division for a company in the consumer space. And we get invited to pitch a top 10 retailer in the country. And the top 10 retailer brought us out. We were excited because we're a brand new division. We're getting an access to a really big customer. And we pitch our tech and they look at it and they go, Matt, that's cool tech. That's actually better than what we have now, but that's not why you're here. I was like, oh, tell me more. He goes, look, man, if you walk in, you want to buy a refrigerator, our current provider is really good at giving that consumer $5,000, 60 months to pay it off. They're really good at that. But we also service SMB, the tune of $30 to $40 billion a year. Our SMB product, if you're a contractor and you walk in to buy $30,000, $40,000 worth of equipment, guess what? You get the same $5,000 credit line and 60-day net terms to pay it off. We want to grow in that space. We want to grow in pro. We want to grow in our SMB. And we need something that feels more commercial, but gives us that flexibility of true private label credit. And I don't want this to go across the street to another competitor of ours. Our current company at the time couldn't do it, would flat out not able to do it. And I said, look, if you've got a top 10 retailer telling you that they've literally begged the largest bank partners in the country to do this program for them and flat out said no. That tipped us off to say how many more people are experiencing this. So being 20 years in, I called everybody in my network. I called out my friends over at Costco. I called Henry Schein. I called Tractor Supply. I was like, what are you guys doing for SMB? And the same answer came back. It was like paper process, not great credit lines, very short terms, feels like it's not exactly a good fit. If you could deliver that flexibility, we will pilot that with you. Saw it on the enterprise side, saw it on the SMB side. Even small contractors who do commercial jobs, they don't have an option. They have it for consumer, but they don't have an option for commercial. And that's where I said, look, the demand is just off. It's at a decibel level I've never heard before. And we decided to kick off.
I need to point this out for all the other founders that are going to be listening. One of the biggest mistakes founders make is they start off with a solution, then they go looking for a problem. Maybe it's a personal itch, and they say, okay, I think I have a solution for this. Now let's go shoehorn it into the marketplace. And so they build something, they spend $150,000 a YOLO in their retirement savings, all that stuff. And then nobody cares. It's not going to go beyond. There's not enough big enough market, you haven't proven demand. And it's tough. It's really tough. Now, what you did is you literally stumbled over a problem. It was like a thread, and then you started pulling on it, and you did all your customer discovery idea validation right up front before even you even laid a single line of code.
I searched out every pessimist in my network. Like I said, I'm a serial entrepreneur. Entrepreneurship, and they say being a founder, you got to be kind of risk taking. I'm actually relatively risk averse. Come to find out, so I searched out every naysayer in my network, mostly in the risk and compliance team. But I said, look, am I crazy? Am I missing something? Is there a solution out there that we haven't seen today? And every single one was like, no, this is a wedge. Like, this is a wedge into the market. And that's where the idea sessions started happening in terms of, okay, if you get in with the tip of the spear on, you got these tethered lines of credit, what else could you do with the SMB relationship? Because that is the mecca of where lenders want to be. You got treasury, you got credit card, you got all kinds of product sets that every lender would want to participate in. So love the idea of going in, but that 1-2 punch combo, it's like, Matt, if it ain't $1 billion idea, which I think it is, it's definitely $500 million idea. And I was like, okay, what's that? Thank you. If the most pessimistic guy I know in the world is saying this is an idea, like everything feels much better.
Another principle that you did is you said, why now? Why me? What's different? You went and asked everyone, and you turned over every stone. You validated what you were thinking. Not only that, you validated the problem, but you probably got a whole bunch of people that were like, Matt, if you can figure this out, like, I'm going to love you. You come call us. And so you got your customers already lined up. Now you need to start building a product. What did you do to get that first piece of code out? MVP, walk me through the process.
We actually didn't do a single line of code. What we did was spend the majority of the time with the founding team going through what the end user experience is going to feel like. And we had a Figma really just drawn up that says, show me what an application is going to feel like. Show me something I can put into the hands of these buyers, the suppliers, and the bank partner where they can see it. And it may not have a single line of code standing behind it, but they can feel it. It's tangible. It doesn't have to hit a server. You click the button and it's dynamic and they know what you're trying to do. And that's when they actually buy in. Whether it's in the cloud, it's on-prem, it's hybrid, that comes later. What we built out was really a prototype that for very, very efficient capital, because we didn't have a ton, that said, how can I put something into the hands of these targeted clients and say, this is what Transend's trying to deliver. What do you think? And there was iterations on that. Like there was a bunch of like, well, what about this? And what about that? Can you guys do this? Can you guys do that? But it was that information gathering session where we would do iterations of this Figma and go, what about now? And at this point in time, Ed, I've stopped doing demos because every time I do a demo, everyone goes, send me the contract. Let's go. Can we go now? And it's like, wait, hold the reins back. But it was like, that's all they needed to see was, let me feel it. Let me touch it. Let me actually materially understand what you're trying to do.
What did you show investors for traction? Typically pre-seed companies don't have a lot of traction and they have to show significant tractions for very little resources. They have to show that they're exceptional. What did you have to show investors to have them sign over $1 million at your stage?
Yeah, 2023 wasn't a great year to go out and VC money, contrary to popular belief. Was kind of like when the party was getting called out. That said, your point is spot on. A lot of the conversations we had were no's. Like it was flat out no's, and some of it was us. I'm sure some of it was VCs at the time were just being very cautious and selective about where they're going, which put additional pressure on traction and what traction means for a pre-seed company. It used to be, your resume and a slide deck could get you a raise. and you could get enough to get out, get dirty, have an MVP, and start to actually build out. Here, they want to see real traction. And real traction to me was supply and demand. Like de-risk your business for me. Show me that you have the demand lined up and the supply willing to go. Because if you've been around this space long enough, you know that supply is hard to come by for bank partner. You got to go find funding. Funding is not easy in this day and age of high inflation, right? Banks are pulling back, being a little bit more restrictive on where they park their capital. The requirements for returns are significantly higher. And then even if you get that, show me why somebody would even sign up for this. Show me the demand side. And so I spent every single waking day out building the demand, doing demos, getting everybody in a demo where they could sign up and go, I will pilot that. Send me a letter of intent. I will sign it. Absolutely. And so when you start to stack logos on the demand side, then you go out and you target the suppliers. You target the bank partner. And so that's where we kicked off our discovery sessions with lenders and said, hey, this is not consumer. This is commercial. And then as soon as they're, oh, it's commercial, like I'll stay on the phone with you. Then it started to get into what we can deliver, how we would deliver, what are the structures. And then it was, you have these logos lined up, then we're excited. Let's pilot this program with you. We had to put all that together before a single dollar was invested. And so that's the traction that we needed to kind of eclipse. And a lot of that was spent with limited to no resources. So
let me point this out to the other founders again. What I want all other founders to hear is that this is about founder market fit. It's not just problem solution fit or founder problem fit, but Matt was in the market. He fit the market. Matt, you could call people up like Costco, people that you knew inside Costco. It's not someone can just come off the street and say, I want to talk to that person, that compliance individual. And so because you had those relationships, you were able to get that done significantly faster, which a lot of founders don't. They try and solve a problem where they're not a fit in the market. They don't have context. They don't know people. They don't know experts. They just sounds really great in their heads when they're sitting in their coffee shop plunking away at their Figma model. And they're like, I'm a genius founder, right? But you actually were in the marketplace, which is really great. Yeah. Just so that other founders understand what you had to go through. How many investor calls did you make? How many times did they say, come back to us when? Like, what was that like? Because you're right. We're telling all the founders now, 2023, the party's over. It's not going back. There's a new normal out there. Get ready.
I remember those calls. And they were, I got to tell you guys, like that was some of the more supportive times where sometimes I just felt like I need to get on a Startups.com call because I'm feeling it this week. We talked to a lot. I think I kept signed up for the free HubSpot, kept all of my contacts in HubSpot, treated it like a sales process. But just again was spray and pray. I did not have a ton of folks. So I targeted, there were well over 50 that were no's. Come back with more traction. Let's stay in touch. Show me when you post revenue. And some of that's my fault. I was targeting companies that clearly only invested in Series A and beyond. And so like those were great conversations to have, and they led to other conversations, but it was a no. It was still a no. And that's tough as a founder to kind of hear because you got your baby over here, right? Like, you know that this thing is going to be successful, right? In your true heart of hearts, you should know that you've got conviction in what you're doing. And when you hear no, that's just super challenging. So yeah, we heard no a lot. And it was that old adage, like, you're only 27 no's away from your next great idea. Like, keep going, right? I was checking them off. I was like, 28, 29, 30. It was like, how many are we going to get here? But it's the startup life, I guess. You get the tremendous highs, like we just talked about, but does not come without the tremendous lows. You got to have a level of grit with you to kind of pursue through it.
Matt, I remember the first time meeting you in one of our Startups.com cohorts. You're bright-eyed, bushy-tailed. The way you talked, I'm going to tell you right now, like, I think it's a testament to who you are as a founder and a learner. The way you're talking now is so much more grizzled and wiser. You've been weathered.
Is that a good thing? Is that a good thing?
But here's the best part. Like, it's like talking to a different Matt, which is cool. But at the same time, you've remained humble. The way that you're talking right now, you're just very open about the lessons you learn. Let's dole out some advice for other founders. You said you first came in and you're targeting the wrong investors, this and that. And then at Startups.com, we gave you advice. Give the other founders listening the same type of advice, just through your personal lens that you received and what you think all of them should know.
No, I appreciate that. That was a very kind comment. I think, look, it's that old adage where I tend to try and just think I could figure my way out through things. That's kind of been my entire life. But one of the pieces of advice I received earlier on in my career is try to find the people who've been down the road before. Like, actually go and pull them into your network. So I had a lot of missteps earlier on, even before Startups.com. I think one of the pieces of advice I got was like, wow, Matt, your pitch deck looks like McKinsey wrote it. And I was like, oh, as a Duke MBA, I'm like, thank you. And he instantly goes, that's not a compliment. And I was like, oh, okay. He goes, no, look, you're very intelligent in the space. You clearly know the area, but you are talking like an engineer, and I need you to talk like a trucker. And so I need you to have several iterations of your materials, your deck, what people look at, and truly can understand what you do. That was great advice. And I did those iterations. And then when I brought that to startups.com and went through Will's Deck 101 course where he's literally shredding things apart and putting it as simply as he can put it for you without, sounding offensive. That's what I needed. Like, that's exactly what I needed. So finding out, look, get your materials together, put the thought process together, and then go start understanding what process you're about to go through is and who VCs are and what stage they invest in and who they're looking for and what their prior port codes were. Like, those kinds of pieces of information were just so new to me. I was out thinking I was just going to talk to a bunch of people and get some money because, well, I thought it was 2021. So
I'll confess, at first, when I heard what you were doing, I didn't get it. And I think this is because you were still working on your messaging and everything like that.
Yeah.
But it was Elliot. And this is what happens at startups.com. We socialize internally. When we hit a founder, we're like, oh, geez, this is a live one. Like, we're looking at a baby, right? He saw that in you and he got into my grill and he was like, Ed, we got to work on this thing with Matt. And I was like, I don't get it. And then he laid it out and I was like, oh, I get it.
Oh, I get it. Yeah.
Yeah, that was what was really helpful. And I think being part of a community to put some reps in and allow us to help each other socialize, because when you're looking at forest for trees, like, I'm really crappy at pitching my own startups, right? And I do decks and raise money for people all the time, but take my own startup, I can't do it to save my life. And that's the benefit of having all these other people have your blind spots, different perspectives, contribute.
Bring those people around you. And then, because one of the other pieces, I'd have to get this out to other founders because I found this guy way too late in my journey, but he was a multi-time founder, had raised, I think it was over $100 million for his startups over the course of his career. And he posed the question to me. He was like, what process are you running? And I didn't know how to answer the question. I'm like, wait, what do you mean? Process? Like, I'm just talking to people. What do you mean process? There's a process? He starts describing his process and how he raises money. And it was clearly a novice listening to a professional.
Yeah.
And, he's like, look, get your stuff together, practice your pitches, record yourself, start actually looking at where you can shorten things down, you can elaborate, feel how it feels to be on the other side of what you're talking about. But then he's like, you want to create and craft your list. And you guys go through this at startups.com. He puts a nice little cherry on top in terms of like some very tactical experience that I've talked to a few others and they said they've agreed with it or not, but take it as it is. So he goes, look, craft your list of people who you're going to reach out to. Start doing some soft sells, saying, look, here's the company that we're thinking about raising for in the next several weeks, month, because everybody is available in 3 weeks. It was his advice. He goes, nobody's available this week. And next week might be dicey, but in 3 weeks, you could probably find 30 minutes. So go to your Calendly, park a 2-week spot, 3 weeks in advance, create that, and then have that ready to go to start sending to investors. Say, we're considering raising for this company in 3 weeks. We're setting up times right now. Have a couple of slots in there. Obviously, they're unavailable. So when VCs check in, they could actually see that there's a little bit of FOMO, right?
Nice.
I didn't realize how much FOMO really exists in this world, but it is not insignificant. Mm-hmm. And so having that there was one where he said, and if you could craft it to where you actually have. And he started tiering VCs. He's like, if you have like tiers A through C, start with your tier Cs and really try to get the round, whatever it is you're trying to raise, to at least to be around that 60 to 70% full, right? Committed, truly committed. And then bring in your B's and A's. Because what's going to happen is they see that people are interested. They see you have traction. They see you have investment, but they want to write the big check. And then all of a sudden your round becomes competitive. Good for you. I was like, man, I'm already at kind of like my $1 million mark. I don't know if I need any more money, but I really wished I would have met you 6 months ago. that would have really helped out a lot. But nonetheless, he was very helpful and continues to be helpful to this day, and actually came through Startups.com. So
that's a great piece of advice. You don't plan to raise again. That's interesting because we come from the old days up until 2023. It was the factory model. You do the seed, you do the A, and then everybody's wanting to sell you upstream. I'm wondering, you're telling me we don't plan to raise again. What do your current investors think about that? Like, are you going to play that game? Because as you pointed out, it is a game. Investors need deal flow. There's a flight to quality and they get very competitive with each other. And the FOMO is a real thing if you can create it. So how are you going to approach this whole factory model? What's going to happen there?
I think actually it was you who did a video on the reality of venture capital
Yeah.
and the incentives behind each. And to know what you're getting into when you take this money and the expectations of your company when you actually take this money and what you need to deliver on. And that was super helpful because with our current investors, that was a conversation that said, look, with the model that we have, the way that we actually generate revenue, there's a lot of upfront revenue on this. And our burn rate is not that high. It is a very real world scenario where next month we are profitable and profit never goes out of style. And it's one of those where profit could drive the growth of the company. The question becomes like, okay, well, what could you do with another $10 million in the balance sheet? And can you do it through the profit that you would drive this year? Or could you grow bigger with all this demand that you've got out there to say, hey, we actually do believe that we need some investment and we will take another round. So the conversation with the investors back to that was, look, this is the structure in the model. We may not raise again. Are you comfortable if this becomes a very nice distribution paying company? And having that conversation up front was very helpful because it gave us the flexibility to have this conversation. Other than that would have been, when you're raising your seed, when you're raising your A, when can we get you scheduled for the B conversations? Like, what does that $2 to $3 billion exit timeline look like for you? Because that's what VCs need.
And thankfully, those days are gone. I've literally had conversations with founders where the VCs come in and say, you need to take another $2 million and 25 cents on every dollar needs to go to AdWords or Facebook ads or different things like that. They're literally telling you, light my capital on fire for growth.
I remember you exactly saying that thing. I was like, that lodged itself into the back of my brain in every single VC conversation that I had. And when normally the questions are like, well, what's your average check size? And when was the last time you invested and all those things? Mine was, what is your forecast or what are your expectations when you actually put money in? Now at pre-seed, thanks to the safe note, it made it pretty straightforward in terms of what that money could mean to you.
Sure.
And levels of control. But like at later stages, it becomes a priced round and those contracts can vary quite a bit to what you're saying, up into including board seats. So,
and that takes a founder with tremendous maturity to keep that and be regulated when you've got VCs and they're dangling money in front of you and A rounds and B rounds and all this stuff. I'm going to picture that you're going to get to different inflection points and you're going to continue to communicate that to the market and the capital will be available. Like I've got a founder, they were profitable in month 3, 40 million users, bootstrapped, and they get a call from a VC every week, right? So hopefully you can get to that stage, but when you can use the capital and you've got a clear exit strategy in mind, I'm hoping and I'm believing that's inevitable that you're just going to have access to the capital at that moment.
It's an odd feeling to have when outbound becomes inbound on that side of the house, because it was all outbound before. And now we are actually receiving inbound and offers and valuations that are significantly higher than what we raised our little $1 million at. And so it's going to be tempting in a lot of ways. But for us, I think staying true to, look, we still have the firm belief that small, mighty teams can outperform massive organizations. And we're going to continue to have that as a thread throughout the company. So
I know on behalf of all of us here at Startups.com, we couldn't be happier for you. Looking forward to seeing where your success goes and how we can continue to help and support you. My last question is this. So run a scenario. I have your family hostage and I will not release them until you wrap everything up and you give one piece of advice to other founders. Could be anybody that you imagine out there listening that's going to haunt them with enduring value for the rest of their lives. Your legacy here on this video. What's the advice that you're going to give everyone?
Man, I gotta plug my guys at Startups.com. Man, I don't say that lightly, guys. I mean, it is such a, if you're a first-time founder or even you're a second-time founder, it can be a challenging journey. And what you guys have put together, everything from debt creation to even the podcasts that you do, which are fantastic, all the way to Will's ability to host his sessions about like the challenges of being a startup and the times it's not going to go well, it's going to fail, and what are you going to do? Those were all I had to turn to for a long time. So I would say you got to find that network for you that actually works, and I would say you guys put together something special. So
I appreciate that. I'd like to say to all the founders, I encourage all of you to listen what Matt said, what he was talking about, because this, I believe, represents the new mindset of the new founder for this next cycle of startups, ones that are interested in generating profitability right out of the gate, ones that do a lot more customer discovery and create market demand before they actually build anything, and take money at the right times and have the right perspective on that, and stay humble for the whole thing. Matt, I appreciate everything you shared.
Ed, you're awesome. Appreciate you, man.